Good afternoon. Good afternoon, Ridham. Good afternoon, everyone. Another great learning opportunity for us on millenniummams online platform. And today, our guest of honor is the MD of Morgan Stanley India, Mr. Ridham Desai, who feels a ferocious bull market awaits and market leadership to see a major shift. And that is, Ridham, I would say, it's a music for our ears. Thank you so much for being on our forum. And I know all of the members who have joined today, they all want to hear what Ridham has to say. But I would like to introduce, before we start, our mentors and my organization, two wonderful human beings. One selfless cause to empower women with investing as a tool, and millenniummams was born, and we are 28 years old and still going strong. The proof: women investors who can give any investor, male or female, a run for the money. Thank you, Dhanuka sir and Bhuvania sir. We'll forever be indebted to you. We take our learning very seriously, and so we are continuously having our online classes, regular classes on investing principles following the tenets of the investor Warren Buffett. Please be on mute, all of you. Please be on mute. Yeah. And today is a big day for us because we are going to start a fresh chapter on Invest in Yourself, another session with Mr. Dhanuka, where we have invited outside, those who are not members, our guests, to be a part of those sessions. And it will start today at 6 o'clock under the brand of Invest in Yourself by millenniummams. And we also took a trip to Omaha last year to attend the Berkshire Hathaway AGM and to listen to the investing legend in person. Seeing 40,000 investors from the world over under one roof was quite an experience for us. And 29 of us were there attending the AGM last year. An investor at the age of 13 was talking about delayed gratification. So it was an experience, and it was the second time we attended the AGM. First time it was in 2012. And hopefully we are thinking of attending again next year when things will be all right. Our guest of honor, Mr. Ridham Desai, he also started early in life, an MBA from Wellinger Institute of Management with 23 years of investment experience. Ridham has always had an eye for market trends and been able to analyze unprecedented situations with extreme precision. His father has been his mentor. He has been trading in stocks since 1985. He collected and read annual reports as his hobby. He is a positive ray of hope amidst all the negativity surrounding us. And today we will, and I'm sure we are going to get an opportunity to understand his perspective in these unprecedented situations and times. Let us all welcome none other than Mr. Ridham Desai. We are all used to seeing him on ET Now channel and CNBC and many other channels, but today he has made it to our millenniummams platform. Thank you, Ridham. Thank you for gracing our forum. And with this, I would like to invite you to address our members, and then it will be followed by Q&A.
Thantthank you, Rachna ji.
Over to you.
Yeah. Can I be heard?
Yes, we can hear.
Yeah. Okay. Thank you, Rachna ji. And I must say that she has been diligently pursuing me for the past several months. And for some reason or the other, we have not been able to undertake this session. So I'm very happy and glad and honored to be finally on this in this gathering. And I'm really amazed to see so many people dial in. So hopefully we can make this a productive session. I prefer interactive sessions. Yes. I I don't like to give long lectures, but what we decided between Rachna ji and me was that I'll probably give some
Ridham, Rachna is
remarks.
fine.
Yeah, okay, Rachna.
Yeah.
I'll give some opening remarks on things as I see them, and then maybe we can go to some questions.
Absolutely.
So yeah, we are obviously living in unprecedented times. That would be a very cliched thing to say, given that most of us are locked down. At least in Mumbai, we continue to be severely locked down. The lockdown in Mumbai right now is no different from how it was across the country in April. We have very little movement, and we are pretty much in our homes. Mumbai having been the epicenter of the virus, but the virus has been across the world, and there are several debates about this. For those who are familiar with statistics, this episode is in the fat tail domain. It is not subject to averages. It is not subject to our normal thinking. 250 years ago, a mathematician by the name of Gauss had made a very powerful observation that if you took the heights of people, a large number of people, and plotted them under a chart, the shape of the chart would be a bell curve, which is known as normal distribution in statistics, also known as Gaussian normal distribution. So most natural variables tend to follow that pattern, but subjects in the social domain do not follow that pattern, like stock prices. So returns in the stock markets do not follow a normal distribution. Yet all the tools that we use in finance make this assumption that stock returns are distributed under a normal curve. Because without making that assumption, you cannot actually propagate a theory. And that's why all theories about stock markets eventually prove to be wrong. So if somebody comes and tells you buy in December and go away in May, that will not work. It will not work. It may seem to work, but when it fails, it will fail so spectacularly that all the returns you made in your previous trading ventures will be gone. And that's the nature of stock prices. It lies in the domain of fat tails. Nobody saw March coming, and nobody saw April coming either. I mean, we all talk about March and the fall that happened in the stock markets. But remember, in April, stock prices were up almost 30%, and nobody saw that coming. I mean, a few people did forecast that. I made a forecast as well. But the point is that we cannot make these forecasts on a recurring basis with assuredness. And that's the nature of stock prices. That's also the nature of the COVID virus. So the virus has got strong resemblance to stock prices. It's in the fat tail domain. It is not subject to forecast. Anybody who makes forecasts about the virus is going to be wrong. If he turns out to be right, if she turns out to be right, it's going to be by pure luck. Do not compare this to heart attacks. Do not compare this to diabetes. Those are all under the normal curve. I can precisely forecast how many people in India will die of a heart attack in 2021. There is no way we can forecast how many people will die of COVID virus in the next 12 months. So that's the difference. The other difference is that heart attacks are independent events. So just because I get a heart attack doesn't mean that somebody living with me will get a heart attack. But with COVID, it's not an independent disease. The likelihood that if you get it, the person living with you will almost certainly get it as well. So there are these marked differences in COVID, and that's why it's not something we can forecast with great deal of accuracy. And therefore, it resembles stock prices, because stock prices also cannot be forecasted with great accuracy. Yet I have been in the business of forecasting, and I do that job. But you should not take my forecast too seriously. They have to be taken in a very light-hearted manner. In fact, I would almost say that just get entertained by them, and do not take them very seriously when I say that this is what I think the index is going to do. Because frankly, I may go right as often as I go wrong. And I keep telling people that my forecasting track record is not very different from the toss of a coin. So if you tossed a coin or you listen to me, you probably get the same result, which is 50% of the times you'll be right and 50% of the times you'll be wrong. So it's not about forecast. Investing in equities is about duration. It's the longest duration asset class. It gives you returns in the long run. In the short run, if you make money, it's just pure luck. And I'll actually go into this subject about luck and skill as we progress through this chat. So over to you, Rachna, with your questions, and then
Yes.
we can open it up for further discussion.
Absolutely, absolutely. So Ridham, just as you said that you just can't forecast a market in the same way you can't forecast about COVID, but through your experience, you can foresee a few things. And keeping that in mind, I would like to ask you that in 2018, in one of your interviews, you had mentioned that the point of maximum fear is the point of maximum return. And even the legendary investor, Mr. Warren Buffett, has said that be fearful when others are greedy and be greedy when others are fearful. So according to you, is this the right time to be greedy? And in other words, is this the point of maximum return?
Actually, the point of being greedy has just gone past. That was the month of March. One had to be very greedy then. Mm-hmm. Things have normalized now. But it's a very useful question that you are asking because, as I said, stock markets lie in the class of social variables. They are not subject to forecasting like you could forecast the height of a person or the average height of a certain group. And therefore, for those who want to actually exit and enter stocks on a regular basis and are not necessarily invested for the long run, only extreme points actually offer that certainty. So when there is extreme greed in the market, or as we call it as bullishness, or there is extreme pessimism or bearishness, I think those are the times that you can use to act with greater certainty. You can never have 100% certainty, but greater certainty. So we certainly hit a point of maximum fear in March. And mind you, not a lot of people were buying stocks in March because they were not sure about where the COVID virus will go. And that's the challenge with points of fear and points of euphoria, because at the point it always feels that things are going to go further in either direction. So it takes enormous discipline, but more than discipline, it takes a lot of stomach. It takes enormous courage as well. Charlie Munger, Warren Buffett's less famous partner, who I have a lot of regard for, and I think he's probably the most insightful thinker in the business of investing. And he's somebody everybody should read. There is a lovely book about him, which is called The Poor Man's
Poor Charlie's
Poor Charlie's Almanac.
Poor
Charlie's Almanac. So that I think is a very useful book for people to read. And Charlie, he talks about this a lot, about the fact that stock markets are a function of greed and fear, and I think it's not IQ that is required to succeed in investing.
Absolutely.
What you actually need is emotional stability. So in fact, IQ is a hindrance because at those extreme emotional moments, you want to actually stop thinking and just be stable. And if you overthink, then you actually miss out on those opportunities to invest. So for those who are looking to time markets, I think.
Just a second. Yeah.
Oh, sorry, I got muted. Sorry.
Oh.
Okay, so for those who want to time markets, how do you know whether you can be a good trader or not? You should make a self-assessment about your emotions and how quickly you are able to, how quickly you get excited, or how quickly you get depressed, or how quickly you get anxious, or how quickly you get euphoric. If those things happen very quickly with you, then you should not trade.
Okay.
Because trading requires a lot of patience and enormous amount of emotional stability. Investing in general requires a lot of patience. But as an investor, you can get away with lack of emotional stability if you don't look at stock prices on a daily basis. But if you're looking at stock prices on a regular basis, then you need to do exactly the opposite of what your head is telling you almost all the time, because you don't want to fall prey to emotion.
So normally at millenniummams, we don't look at stock prices on a daily basis. Like, it's a long-term investment. We have to invest and forget. So Ridham, according to you, what is the narrative in next 10 years, or what is your view on India's story? Yeah, because we want to look at long term, like, 10 years.
Yeah. So I am very bullish on India, but I have been bullish for a while. Things have not necessarily worked out in that way. But I think we have a very good confluence of factors that are favorable for us. And we can only hope that policymakers across the country respond to these and take advantage of these factors. So very well known is the fact that India has amongst the best demographics in the world. So we have a young population. But it's also a very aspirant population. So it is willing to take risks and build businesses. We also have a very low starting point at $2,000 per capita income. Really, we can't do worse than what we're doing right now. The likelihood is that we will get better. You must understand the context of earning just $2,000 per person. A large portion of people's income, the average person, not us, but the average person's income goes in buying food. But as that income grows, you don't need to consume more food. Actually, at a point comes when the amount of food you consume as a percentage of your income peaks out, and then you get a lot of spare income, and that's when you get exponential growth. So that's why I'm very positive on consumption, because I think we are entering that era where our income growth will basically mean that we'll have a lot of spare income, because food consumption may not rise that much more. I'm also very constructive on the fact that India has very fertile land. Now, some of that fertility has declined because of bad use of fertilizers, but with the new things that we have done in terms of soil testing and the Aadhaar-based distribution of fertilizers, things that we've done in the last 5 years, I think we will get surprised on the upside with the amount of food that this country produces. So, just to recap, India has about 700 million acres of land mass. Half of that is under agriculture, 350 million acres, and that number is largely unchanged. In 1950, that number was around 355. Today, it's 353. We have not lost any amount of farmland to industrialization or to infrastructure. It's quite remarkable. I don't think there's any other large country in the world that has 50% of its land mass under agriculture. We are in percentage terms, it's the biggest. It's a very remarkable thing. And now, if you look at what this farmland does, it's distributed across 137 million farmers, 13.7 crore farmers. So on an average, each farmer owns only 2.5 acres. And in fact, a large number of these farmers own less than 1 acre of land. And with that type of small holding, you cannot really subject it to scientific inputs. You cannot subject it to tractors. You cannot subject it to irrigation. You cannot subject it to hybrid seeds. And therefore, the productivity of our agricultural land has remained low. We are about 1/4 of China. We're 1/10 of the US. Theoretically, if we went to Chinese levels, our agricultural output will be more than $1 trillion, which is half of India's current, or about a third of India's GDP, say, in the next 2 years. So it's an enormous potential that we have. If we went to US productivity levels, and that's theoretical because we're not getting there anytime soon, nobody in the world will need to produce food. We will supply food to everybody. That's the amount of potential we have in agriculture. So I think that we have reached that tipping point where we will produce a lot of food. And therefore, it was necessary that we liberated the sector from the archaic marketing controls that were in place for the past 70 years. And fortunately, we got that. And this is the upside of COVID, that it has pushed the government to liberate the sector from the erstwhile agricultural controls. So this, I think, does open up a potential for the sector to consolidate, for the institutionalization of the sector, for a greater reliance on irrigation. We are capped at around 50% in terms of irrigated land. That's not because we don't have ability to invest in irrigation. It's because the remaining land holdings cannot be subjected to. It's too expensive to bring irrigated water to 1-acre plots. So consolidation is important. And I think, if you add the non-landowners who are also in farms, 50% of India's workforce works in agriculture, and it produces 15% of India's output. So from here, I can only see upside. And last bit on the farm sector, in 1920, the average farmer in America fed 20 mouths. By 1960, that number was 250, which is why America became the most progressive country in the world, because the number of farmers required to feed the country dropped by about 1/12. India today, the average farmer feeds about 5.5 mouths. So basically, he or she feeds the 4 people in the family and then half a mouth outside the family. Imagine if that 5.5 went to 20, what will happen to India? So it will be a massive revolution. And that will lead to a very big growth in consumption across the board, from the lowest level to the highest point in the pyramid. Everything will get unshackled. And I think this is also what Aadhaar DVT plans to do. And a small note on that, it's less understood, it's less appreciated, but it's one of the biggest revolutions that has happened in India over the last 5 years. Because what it does is, it allows the government to transfer the tax that it collects to needy people without the erstwhile leakage. Remember, a few years ago, our public distribution system contained of big paper ledgers where people came, signed, and collected their stuff. And that was subject to a lot of middlemen, a lot of leakage, a lot of corruption. Today, with direct benefit transfer, the government can undertake these transfers without such leakages. So the efficiency of the transfers go up. They reach the people who require the help, and then it allows them to actually spend the money they want to. See, hitherto, the government decided everybody will get free rice. Now, I may not be a person who wants free rice because I'm already making a lot of rice on my farmland. What I wanted was wheat, or what I wanted was to send my children to school. Today, a large portion of India's social transfers are happening in cash. And therefore, the choice of how that money has to be spent is being left to the poor person. And you'll be surprised that a lot of these poor people, contrary to what popular press says, will not actually be buying alcohol, but they'll be sending their kids to school, they'll be painting their houses, they'll be buying mobile phones, they'll be buying tractors, or whatever they need to take their life to the next level. So this revolution is happening, and it all basically, the sum total of this is that I think we will see a very big growth in consumption. The second thing is that we need to increase our trade with the world. It has stagnated in the last 6-7 years at about 2% of world trade. Frankly, if that number doesn't grow, we really will not become rich. How does a poor person become rich? A poor person becomes rich by trading with rich people. If poor people trade amongst themselves, they do not get what we call in economics as transfer of terms of trade. Terms of trade is basically what price you can charge for the service or the product you bring to the table. If a poor person brings his ability to clean utensils to another poor person, he'll get paid very little money. But if he brings it to you, you will pay him a lot more for that because you have a more ability to pay for it and you value that service more. So it's important that we enhance our trade with the world on an exponential basis in order to benefit from that transfer of terms of trade. By the way, this is exactly what happened in the 16th century. As anecdotes suggest and some data suggest that India and China, and in fact specifically India, may have been the richest country in the world and was hectically trading with the rest of the world. We transferred enormous terms of trade to Europe. Europe was far more impoverished than India was in the 16th century. And because of the trade that Europe did with us, it actually gained enormously from it. And eventually, of course, it took over India and transferred everything that we had to Europe. So all the gold and all the richness you see in Europe, a lot of it came actually from their trade and then, of course, their occupation of territory in India. We need to reverse that by now resuming that trade in great earnest with richer countries. So that's the second thing I'll say. And the third thing I'll say is that the outlook is going to depend on how the world does. Now, unfortunately for China, it undertook reforms about 13 years ahead of India, and it hit a very big sweet spot in global trade, which was the 90s and the first decade of this millennium, at which time global trade was flourishing. And as a consequence, China will not have the same beneficial period in the next 20, 30, 40 years. Global trade may not flourish in the same fashion. If anything, it looks like countries are closing their borders. This may actually present us with some external challenges to face. Look, on a 10, 20-year basis, doesn't look as good as it was, say, 30, 40 years ago. So I remain very constructive. I think for equity investors, there's a lot of money to be made. India has delivered less than its run rate of return over the last 10 years. The last 10 years for equity investors have been very challenging. They've not been fruitful. And I think this may change in the next 10 years. I think the starting point on valuations are better. We've undertaken a fair bit of reform. We've made a few mistakes along the way, but I think we're now set up for better growth. So better equity returns. But equity returns will not go back to what we saw in the 80s and 90s. There was a point in time when the compounded annual return in India was over 20%. I don't think that should be your expectation. The expectation should be far more moderate because inflation is going to be a lot lower, and therefore interest rates will be lower, and global growth is also going to be lower. So I think a return of say 11 to 12% on a long-term basis is a more reasonable expectation. If you do better than that, it's fine, but you have to keep your expectations lower than they have been in the past.
Yeah. Thank you, Ridham. Yeah, and it's very encouraging to hear that the growth story of India is coming from agriculture and agriculture sector. And we at millenniummams, we take it very seriously and we have studied a lot about the sector. But it's really, I would say, music for our ears that it's coming from you, because very few people, they talk about, agricultural sector and betting on those sector and studying about it in detail. And our mentors, they are really bullish on, especially Mr. Dhanuka is really bullish on agricultural sector, and it is going to be the driving force, I would say, and the growth story of India will be in future from the agricultural sector. And Ridham, with your permission, I would like to take few questions from my members. They're eagerly waiting to ask questions. Yes, Sirisha, you can come in with your question.
Good afternoon, Ridham. This is Sirisha, and my question is on the new opportunity that COVID has thrown, and one of the sectors is the insurance sector. What is your take on the future of insurance sector, especially with respect to listing of LIC?
So I will not go into specific securities here, but see, I don't think COVID has in India so far has changed our long-term behavior or will likely change our long-term behavior, because we are actually coming out relatively unscathed from COVID. So if the current situation persists, yes, we'll get a lot of people who are infected, but we are not going to suffer the type of death rate that we saw in the Western Hemisphere. So countries like Spain, Italy, France, the UK, and the US have suffered fatalities which are far in excess of their normal fatality rate. And they are certainly going to probably go through some structural shifts in behavior. In India, I think, as soon as we open up, people will be back to the place where they were in March. And I think we're already seeing that happen in places which have opened up. So I don't expect structural shifts. So the insurance opportunity remains as it was in March. I don't think COVID has shifted it dramatically. And it is very huge because we are an underinsured country. We have, and the reason where we are underinsured is not because people are more risk taking in this country. No, there is no affordability. You can buy insurance and secure your future against accidents, against health crisis, and against death only if you have spare money in your bank account to buy that insurance. So this is very, it's actually, if you look at it, it is just another consumption item that you can spend on, depending on what residual resources you have after you have met your basic necessities. So as India's per capita income rises, as India generates more spare resources, there will be more demand for insurance products, and I think the sector will do very well. Compared to what it has done in the past. So I think I'll remain optimistic, but it's not COVID related. I think it's a structural story which is just unfolding over the next few years.
Yes, Sonali, you may come in.
In an interview, you mentioned that
we can't hear you, Sonali. Sonali.
Hello, can you hear me?
No, very faintly.
I'll type my question.
Yeah. Next, Namita.
Hello.
Yeah, now it's fine. Yeah, okay.
Okay. In an interview, you mentioned that the next bull market for India stocks is likely to mark a change in sector leadership, with consumer discretionary and healthcare taking the lead. Given the COVID times, how well is the consumer discretionary placed, sir?
Yeah, so this is pretty much in sync with what I've said over the past several minutes, that consumption is the sector that I think which will do very well because of the unfolding of India's story. Financials may also do well, but the performance, I think, will be far more concentrated than we have seen over the last 5-6 years. So if you look at the financials story of the last 5-7 years, a lot of non-banks and smaller banks had done very well. I think the sector will consolidate in terms of performance and probably be concentrated in a few large banks. It will take time for these banks, the smaller banks, to come back, the smaller non-bank finance companies to return to a position where the market trusts them with their money, and therefore they will be short of cheap liabilities. In financial companies, only two things matter: access to cheap financing and risk management. And what we've seen with a lot of small NBFCs is that because they did not manage risk well, now they've lost access to liabilities. So It will take time. I think it will take 3-4 years or maybe even 5 years for them to regain the market's confidence. In the meanwhile, the larger players will, I think, gain market share and performance will be concentrated there. But the consumption sector, I think, will see the opposite, which is that performance will get more and more dispersed because more and more niche consumption areas will emerge in the country, and that will be catered by companies because not everyone can cater to every consumption requirement. So as the consumption requirements of this country grows, even smaller companies will do very well. So I hope you get the contrast in how consumptions may fare versus financials. Healthcare is a very selective opportunity. It's a very difficult one to actually anticipate. The best way you can do it is by buying a group of healthcare companies because it's very difficult to say which company will succeed and which may not. But the reason why we have recommended healthcare is because the valuations of those stocks are very low relative to history. They until recently, of course, now things have changed. But when we had penned the report, it was not a sector that was in favor. So we use this phrase under ownership, unloved, and undervalued, and healthcare fitted all the three. That may have changed to some extent now because the stocks have rallied, so they're no longer unloved and underowned, and not even undervalued. But that was the theme around healthcare. The structural theme, I think, is around consumption and broadening of the consumption basket, and I think that's what you want to look at in greater detail.
Thank you, sir.
Yeah, Namita?
Good afternoon. Good afternoon, Ridham. In an article on the 13th of July, you had said the Morgan Stanley's view on India is neutral, whereas emerging markets like China, Korea, Brazil, and Indonesia are overweight, despite the fact that India was one of the fastest growing economies till the pandemic hit us. You have said that structural changes need to be made, but you did tell us, at the beginning that the country has made substantial changes, especially if you're looking at agriculture and so on and so forth. But obviously, something more needs to be done. Can you just throw some light exactly what you are looking at to change that stance?
Yeah, so the report you're reading is from my regional strategist, and the context of that report is for a 12-month view. Since Rachna mentioned that we want to focus on long-term, I avoided on 12-month views. But in the context of EM, we see better relative opportunities elsewhere. Now, for India to emerge as a relative outperformer, we need to see some changes, and this is an ongoing requirement. India has to use this opportunity to undertake structural reform. One area which I mentioned earlier is agriculture. The other area is labor. Now we're seeing a couple of states initiate change in labor laws. The third area is investments, which is ease of doing business. We haven't really made business easy in India. It is still very hard to do business in India, and we need to see changes there. The fourth area is land and real estate. It's very tough to do those businesses, and they are very high employment sectors. So things need to change there. Now, if you notice, a common thread is that most of these are state level reforms. So they're not central level reforms. They're not something that Delhi can drive. Individual states need to do this. And I think that's where state leadership will be very important. If these reforms come through, then I think India's trendline growth rate could go up. So without these reforms, India's trendline growth is where it is, around 6.5%. But if it went up, if these reforms came through, then there is scope for the trendline growth to go up.
Yeah, Sonia Surana, would you like to come in with your question?
My question is answered. Thank you.
Okay, all right. Srinidhi?
Sir, I wanted to check with you. So in November, we were talking about a 5 trillion economy in 2025. You've spoken about the long-term story. Sir, if you would throw light on by when do you think this number will be achieved? And if there is anything other than consumption which will get us there.
Which number are you referring to?
The 5 trillion economy.
Oh, 5 trillion. So 5 trillion, I think you need a lot of infrastructure investments.
Okay.
So, technically, if I would explain this to you from an economic standpoint, the growth rate is a function of the investments the country makes. Consumption is a collateral thing. It's a fallout. Okay. It's not what drives your growth. What drives your growth is the capital that you put into the economy and the return that you get out of it. So India's incremental capital output ratio, which is the amount of capital I need to put for 1 unit of output, is about 4. Now that's actually risen, which means our capital has become less productive in recent times because of various reasons. But historically, it's been around 4. And if you take the total input of capital, which is about 25% of GDP, you get 25 divided by 4, which is about 6.5% is your trend line growth rate. Now, if you want the trend line growth rate to go up, either you have to increase the amount of capital or investments.
Hello.
Have you lost me?
No. We can hear you. Please.
Yeah. So either you have to increase the amount of investments you put in the economy. So say instead of 25% of GDP, that number goes to say 30%, or you have to improve the productivity of that capital input, which means you have to improve the productivity of the economy. So you need infrastructure to lower the amount of time required to go from one place to the other place. And more than human beings is the amount of time goods take to go from one place to the other place. Productivity can be of many types, right? It could be in terms of labor, land. So if you can increase the productivity, then you can increase the growth rate. So these are the two inputs that determine that. Now remember one thing, if you increase the amount of investments, then consumption will have to decline, because the sum total can only be 100. Okay, if you have 100 rupees, you can put 30 rupees as your investment, then you get left with 70 as consumption. If you put 40 as investment, then you're left 60. So you are earning 100 rupees. Like if I go to a very micro level, if you're earning 100 rupees and you decide to invest 90, then you can only consume 10, unless you borrow.
I can only consuming 10. Yes.
Yeah, unless you borrow. Okay. Now in macroeconomics, all that is actually in one pool. So whether you borrow or whether you put your own equity capital, it's investment and it's 100%. So the investment rate is therefore it cannot go up infinitely. Now, just to give you an illustration, China at the peak was doing 50% of its GDP as investments, and its ICOR was very similar to India, which is why China did 10-11% growth rate for 10 years on the trot. Okay, India's investment rate peaked in 2007-8 at 39% of GDP. Okay, that's why we got to very close to 10% growth rate then. We got to about 9%. Okay, 9.5% was our growth rate then. After that, it has come down steadily. This 39 has been coming down. We need to revive that. That's when economists say we have to revive the investment cycle. That's what we need. You have to revive the investments in order to get more growth. Otherwise, you cannot get growth. So growth will not come from consumption. Consumption is just a collateral thing. It's an output. It's a fallout. What you need in the country is greater investments. You need greater investments in infrastructure. You need greater investments in exports. You need greater investments in agriculture. You need bigger investments in services. And that sum total of the investments will create more growth, more jobs, more consumption, and more growth after that. And it will create wealth.
Wow, thank you so much. That's a completely different perspective. I really don't think we've heard this perspective in so many of our talks that we've had. Thank you.
Very simply put, yeah. And Ridham, here I would like to chip in and ask you one thing. Like first it was Facebook, then Silver Lake, followed by Vista, who invested in Jio. And now Google has joined the bandwagon with 10 billion US dollars investment, which happened yesterday. So what do you have to say about investments in India? And plus, technology, investment in technology and the sector as well, because they have invested in India through digitization fund. So how this is going to bring about a turnaround story in India?
See, India is clearly a very attractive destination for a lot of global companies. Hitherto, they have been very fearful of investing, because investing on the ground in greenfield projects is frightening, if I may use that word. It may be a bit of an exaggeration, but it's not easy. It's not easy for a foreign company to come and set up a factory from scratch with the amount of red tape that they have to deal with. So what companies have preferred, what global companies have preferred is to buy existing businesses. That's been their preferred route. Okay, now things have started changing at the margin, but more importantly, India as a market has become more and more important. So for a lot of companies, India is their fastest growing market and is going to grow in size, and therefore with a 10, 15, 20-year view, they need to establish footprint. So that's why I think we are seeing more and more FDI. I think FDI will continue to rise. Now, separately, there is a separate opportunity that has arisen for India, which comes from the supply chain disruption because of what's happening with US-China trade war. And there is a growing urge for companies to establish alternate supply chains. And over there again, India is an opportunity. This is one that we need to grab with two hands. We need to reach out to companies and incentivize them, create the environment for them to invest, because frankly, nobody should be going anywhere else. Companies should not be going to Vietnam and Thailand to invest. I'm just taking those two countries as names. I don't mean them as such, but the natural destination for people wanting to set up alternate supply chains should be India, because India also has a very big home market. So I think we are seeing some of those things happen. A combination of the fact that India is a very big market and that India can offer alternate supply chain prospects, I think is probably going to lead to more investments. We need to be vigilant and offer the proper environment to these companies so that they can come and invest and grow. And see, if that happens, then that investment rate that I mentioned about earlier will go up and your growth rate will go up. We are not making all these assumptions in our long-term forecast. So if these things happen, then the long-term will look much better, and we may reach $5 or $6 trillion or $10 trillion much faster than what we are thinking today.
Absolutely. Yeah. Next, Suman, would you like to come in?
And do you think that we are ready to be Atmanirbhar?
So Atmanirbhar I think is something that we've been striving for, and I think it is misunderstood if I understand it correctly. I think it is about being a greater part. Sorry, it's being a greater part of the global supply chain. That's how I interpret Atmanirbhar. It's not about being separate from the global supply chain, because there are two interpretations that one can give to this. If the interpretation is the latter, which is that we want to separate ourselves from the rest of the world, then it's not going to be good news for us. Because, as I said in my opening remarks, for a poor country or a poor person to become rich, it is important that that person trades with the rest of the world. So I think we need to become a more integral part of the global supply chain, which we are not today. And you can only achieve that if you are if you're independent, right? And therefore, I think that's the interpretation that I have about Atmanirbhar. I think we can achieve that. In fact, it's almost imperative for us to achieve that. Otherwise, we are not going to be able to eradicate poverty and improve our lifestyle.
Yeah, Neela, your question, please. Okay, Jyoti Barlia.
Hi, Ridham. My question is on the NBFC sector. So how do you see this sector shaping up after the second phase of moratorium is over? I mean, what kind of a hit do you see in this sector?
NBFC will take time, as I said. I think I already spoke about it. I think just a handful of large NBFCs should be fine, but the rest of them will struggle to raise liabilities to fund their business growth. So I think they will generally face shrinking balance sheets. So unless it's a niche business, doing a very specialized business, or it's a very large NBFC with access to the market in terms of funding, I think the rest of the sector will shrink in size for the next few years.
Thank you.
Devyani, we'll have 2 to 3 quick questions. Yeah. We just have 7 minutes left. Yeah.
My question is answered. Thank you.
Yeah. Okay. Pooja Agarwal. Sushila, would you like to come in?
Yes. Yeah. Good afternoon, sir. The US is in a bad shape. How will this affect our market an economy if it does not recover?
The US.
US. The US is in a bad shape.
So the US is actually, in our view, the US is going through a V-shaped recovery. So my US economist is very bullish on the US. But to answer your broader question, the US is very critical to the world economy. So if it doesn't do well, then I think the world economy will struggle. So it's important for everybody that the US does well.
Absolutely.
Thank you.
Yeah, Preeti?
If you go back to 2008, the global financial crisis was largely a US financial crisis.
Yeah.
No bank in Asia was affected. Maybe a few European banks were affected, but it was largely a US crisis. Yet we call it the global financial crisis because it actually hit everybody. So America is still, the US dollar is still the hegemony. So we can't get away with a weak US as of now.
Hi, Ridham. Preeti here. Ridham, the tough times for the auto sector just doesn't seem to end. So how do you see the auto sector faring in the coming year?
Yeah, I think the auto sector should do much better in the next 12 months than it has in the last 3 years. We have reached a level where car consumption last year was equal to where it was in 2013. So just the replacement demand should actually create enough growth once the dust settles down on COVID. There are some longer term challenges around electric and how companies migrate to an electric platform. But electric is not so simple because India also needs to build infrastructure to facilitate electric cars. And then also it's a function of where oil prices are. And if oil prices remain low for long, then electric will take longer to actually come through. So I think in the near term, at least in the next 12 to 24 months, I would be very constructive on the auto sector.
Thank you. Thank you, Ridham.
And Ridham, before we sign off, I would like to ask one question. You have said that in your recent interview, I suppose, that let's focus on what we understand and not on what we don't understand. So could you please elaborate in light of the current crisis, what exactly do you mean by this sentence?
Yeah, so that's very simple, Rachna, because everybody's asked me about what I think is going to happen in the future. Whereas at the start, I had said I have no idea what's going to happen. Stock market investing is not about forecasting. It's about judging what's in the price. So, we have a common phrase that we use in Mumbai called Bhav Bhagwan hai. Okay. So price is king. And if you buy stocks at the right price, invariably the result will be okay. Earnings can go up and down every quarter, and they're very hard to actually forecast. So almost all the questions were about what's going to happen in the future, which I think is, all up for debate. And half the things that I've said in the past 1 hour are going to go wrong, and half the things will go right. Some people will remember only what the right things and will say, oh wow, Ridham made some really excellent forecast. Some people will remember only the wrong things and say, oh God, he's a dumb fellow. But really it's not about the forecast, it's about the price. When you're buying an asset, what determines your returns is the price you pay for it. If you pay a rich price, you will not make money. And if you buy it at a bargain, then you will make money. And how we determine that is essentially make a conservative cash flow forecast. There's only one way to value stocks, by the way. You can't value it using PE. You can't value it using any other metric. The only way to value it is to discount the future cash flows at your expected rate of return and compare it with the current share price. And if that comparison yields a favorable result, which is that the discounted future cash flows are higher than the current share price, you buy the stock. Obviously, understanding that there are two variables there. One is the growth that you have embedded in your future cash flows, and the second is the expected rate of return. Keep both of them at conservative levels. So expect a more return and keep the growth conservative. And then if you still come across the gap in the two, which is in your favor, then you have increased what Seth Klarman has said, the margin of safety. So that's the second concept, is the price you pay and then the margin of safety you have. If the margin of safety is higher and the price is lower, I think the result will be good. And then, of course, the third thing is always have a diversified portfolio. You cannot put your eggs into, into one or two stocks and then hope to make it. Some people do make it, but, those are all flukes. And, I had said at the beginning the difference between luck and skills. So I'll just quickly say that before we conclude.
Yes,
so, luck, how do you determine whether you are dealing with luck or skill? Is basically whether you can control failure. If you can fail deliberately, then it's skill. If you cannot fail deliberately, then it's luck. And think about a cricket match or think about a carpenter trying to make a table. I've used this example very often in the past. A carpenter can deliberately fail by cutting one leg short. The table will not stand. So it's pure skill, 100% skill. There is no luck in carpentry. Now think about a cricket match and Virat Kohli trying to get out at a particular ball. He leaves the stumps open, but the ball is outside the off stump. So he spoons the catch. The fielder drops the catch. So he says, "Okay, I'll stand myself in the middle of the pitch and get run out." And the fielder's ball misses the stumps and crosses the boundary line. So you cannot deliberately get out in cricket. You can most of the times, but there is an element of luck. So cricket maybe 30% is luck, 70% is skill. Now you can try this in stocks, okay? Go back and try to lose money in stocks deliberately, okay? So pick up 5 stocks which are you are absolutely certain are going to go down in the next 6 months, okay? And then tell me the result. I've run this experiment with many, many people over the last 20 years, and most people are trying to lose money and come back with actually a positive return. So they end up making money on stocks that they think are going to go down for sure. Why? Because stock market, particularly in the short run, is largely luck and not skill. In the long run, there is a lot of skill involved. But in the short run, it's largely luck. So this is the problem with all these forecasts, which is that there's an element of luck involved there. There is an element of skill, but it is much smaller than the element of luck. It's certainly not carpentry. I mean, if stock picking was carpentry, then we would all be making a lot of money.
Absolutely.
Okay.
Absolutely. Thank you so much, Ridham. And you've said it all, and thank you so much for the words of wisdom you've given today. And so many things were covered, and it was such a simple manner. Thank you for being there for us today. And we all can see the rhythm in Ridham's logic, isn't it?
Thank you.
Do you agree, everyone? Yeah. So, and regarding the markets, and also we all share your vision. Thank you, Ridham, for that intuitive analysis on the future of the economy. And I would mention here that thank you for making it today in spite of the huge personal loss you have recently suffered, and our heart goes out. And we certainly feel, that God bless you, and you have a great future ahead. We all wish you all the best for your future. Thank you so much.
Thank you. Thank you, everybody. Thank you.
Thank you very much.
Thank you.
Thank you.
Thank you.
Thank you so much.
Thank you so much.
Thank you.
Thank you.